Appreciate everybody tuning in. And let's continue with the corporate Bitcoin treasury. Some very interesting stuff happening here, as we can see with Strategy and Strive. These are the two, in my opinion, only really Bitcoin companies that are worth evaluating and worth looking at. The other one I would consider as an investor is Block, but I wouldn't consider really covering it, as it doesn't have as much interesting information going on about it. So we have Bitcoin per share fully diluted at a 211,157. This is actually down over the past little while. Here you can see that we had basically a peak here at fully diluted 220,429. So they have been diluting the common equity exposure of Bitcoin per share, which is their North Star metric. And actually, Strive has not yet done that. And their Bitcoin per share is 23,539. And this is the CEBE. This is common equity Bitcoin exposure. So what this does is this strips out the preferreds, strips out the debt, and shows you a multiple to the net asset value of Bitcoin compared to the common equity, which I think is a much cleaner way to look at it. I mean, there's different ways to measure MNAV, and I think this is probably the cleanest way to measure it. So if you look at the basic MNAV, if you just looked at market cap compared to Bitcoin holdings, Strategy is at an abysmal 0.63. The common equity exposure, however, is 1.13, and the enterprise value is 1.04. So not too bad. It's not the greatest position. And I think that one thing people should think about here is that if you are investing in the common equity of a leveraged Bitcoin exposure product, that you are taking on additional risk and doing so because you believe there is additional reward to do so. So if the company gets in a position where they need to strengthen their other products, their preferred, or they need to refinance debt, or they need to retire debt, you will be the one that suffers from being a holder. And of course, if Bitcoin skyrockets up, if Bitcoin that they buy outperforms the cost of capital of the debt and STRC, then you will bear the reward as the common equity holder. So all the volatility goes to the common equity holder. I think that some people don't really fully understand that, but that should be understood as an investor. So some interesting news here, which we will cover. We do have time to cover that. The yield has gone from 11.5% on STRC, which is the preferred that is worth covering, from 11.5 to 12%. And the effective yield is 14.5, so it is actually lower than SATA. SATA has performed relatively well in the recent amount of time. I think the lower amount of activity and liquidity has allowed for less arbitrage. There's been less of a magnifying glass on this company. And what's interesting here is the effective yield on STRC was actually higher, and that's because the price was so much lower. Now, what's interesting about that is you have a higher effective yield by buying STRC than SATA, and you actually have this return to par of $100, which is where they're going to constantly try to push the market towards that $100 share price. So you have a higher return on principal invested as well. So the investment, if you're not an older investor, if you're not an investor that bought at 100 and you're worried about the par, or there's all these different time frames and ways to think about this. But if you don't have either of these, and you're evaluating both of these side to side, and the effective yield are similar, but the return to par is less on SATA than it is on STRC, and you expect both of them to be able to go to par within your investment time horizon, then obviously STRC is a better investment. So I thought that was kind of an interesting way to look at it, and we'll kind of continue on from there. Don't second guess that your Bitcoin is safe. Get a security audit through a one-on-one session with me and join the school community, the Bitcoin Masters, to meet other Bitcoiners, grow your network, and grow your net worth.